Hey everybody, it's Mark Pruitt with Strategic Estate Planning Services, and I want to tell you that when it comes to your money, it pays to be strategic. In regards to long-term care, what are your options? I want to kind of line all these out for you. A lot of people come and they go, Mark, what can I do for long-term care for myself, preparing, or for my family who may be already in the middle of care? Many people think that once you have entered a zone of care or a period of care that all your options are off the table, and that's not true. What all can I use? What all tools are available to be able to pay for care? Number one, easiest is cash. Obviously cash is not replenished. It is a spin down. As you begin to use that, you're usually not replenishing it. Sometimes that is what needs to happen, but that is not the same for everybody. So my best advice in the beginning is before you start pulling money from what I call buckets, because you've got all these different buckets, is get with an advisor that can help you strategically figure out where to pull from that makes the most sense from a tax perspective, efficiency, longevity. All of those things need to be considered. You don't want to just start drawing money and hoping for the best. But one bucket is cash. That's one thing. Second thing is if you have securities, you can take securities in some cases. Again, that needs to be evaluated, but take securities and move them to more of a dividend creation type of account. It's number one, more conservative. Number two, it allows you to have care coming off dividends, and the care may be more than the dividends, but anything that can be added to the account helps elongate the process of money, because in care, it's all about elongating the money. Literally, it's all about elongating the money. So creating dividends account is a second option to be able to help elongate that, make it more conservative, and begin to continually draw off of that, even if it's more than what the dividends are creating. Some people ask, Mark, should I take my house and should I sell that and then begin to pay for care? In some states, you'll always want to check with an estate planning attorney, but in some states, if your house is homesteaded, that house can be protected while you are living in regards to being taken for care. And so there's reasons to sometimes do that, sometimes there are reasons not to. Again, that's not a decision you want to make on your own. I would encourage you is talk with somebody, an advisor, attorney together, estate planning attorney that can help guide you with that. But that's a big, large asset. For some people, that's their largest asset. I'm going to give you a thought process for me that I tell a lot of families is this. You kind of have choices. One is, do you want to stay in control of your health care if you're needing care? Or would you want to transition to where the government is making decisions on your health care? I think most people would raise their hand easily and say, I want to make decisions and I want my family to make decisions. And I would agree with that. I want the same thing. Very, very important. If you don't do that or you run out of money, then the government is going to make decisions, and that's called Medicaid. Medicaid is a plan for what I call the indigent. That means they don't have any more assets. They have either spent all their assets up and there's nothing left. Therefore, the government, and I'm glad that we have this, we don't want people to be out on the street with no care when they're in the middle of care. And so there's plans in place for that. The government has our backs on that, and I'm grateful to that. But it's important to know that that's not the choice that I want to choose. I want to stay in control of my health care, and if I can avoid Medicaid, that's what my goal would be. So another option that you can do for this is you can take annuities that are fixed or fixed indexed annuities, and in some cases variables. And no matter what you hear or read about annuities, you need to understand they are not just they are a way to have long-term care, a payment that does not run out. You cannot outlive it. It will pay you for life. You say, Mark, how can it pay me for life? In fact, I'll even go this far. It will pay you to the point that if you zero the account out and there's nothing left, it will still pay you a check for the rest of your life. That is a tool that is rare Because usually bank accounts, once you're out, you're out. Security accounts, once you're out, you're out. If you sold your house, spent all that money down, you're out. In an annuity world that can pay you for the rest of your life, that's a good thing. What's the negative on that? The negative is that you may not have any money to pass down to your heirs. Okay, but what did it do for you? It paid you for the rest of your life. And so that's very, very important. The next thing that people could use would be long-term care policies. Now, the difference in long-term care policies today are not the ones of yesterday. I have a policy that is an unlimited policy for long-term care. Those are not available today. Pretty much today, they're 3 to 5 years in length. And so that's important to know that many people go, well, I don't want to pay for care. I don't want to have to pay for something and I may never use it. My concern is not that. My concern is what if you're living past the 3 to 5 years that you bought? I want to make sure that I continue to have care. I'll give you an example of my own. My mother-in-law had Alzheimer's for 16 years. That's a long time to pay and have care needs all along the way. And so my concern is not the dying. My concern is you continue to live. You're going to continue to need care. Bills stop when you die. They do not stop as long as you're living. I want some of that money that's paying for my care to make sure that it never runs out. One of the tools that we can guarantee that with, as long as you've got the full backing of the insurance company that can pay those claims, is annuities provide that lifetime payout in care. And so that's something that can be customized. Every company is a little different in that and what they offer and how they pay that out, but it is a safety net. So you think about cash accounts, dividend paying accounts, potential homes or not using homes, annuities as an example, the purchase of just traditional long-term care. These are just some examples that are good examples. Some of them you have to qualify for. Some of them you don't have to qualify for. What's the main one out of all of these you have to qualify for health-wise? The traditional long-term care 3 to 5 year policy. The annuities you do not. The home, obviously, dividend-paying stocks, cash, you do not. So there's actually more that you don't have to. So you could be in the middle of care, begin to choose those type of tools, and make a huge difference in the care for your loved ones so that you can stay and help them stay in control of your long-term care scenarios. Hopefully this video has been helpful. You can always call us at 1-800-381-8870. Feel free to give me a call, Mark Pruitt. You can also visit our website at strategicestateplanning.com. I can tell you, when it comes to your money, it pays to be strategic.